With the stock market soaring to new heights in 2024, many investors are asking a crucial question. Is now the right time to invest in index funds? Or is it going to crash down like in the 2000 dot-com or 2008 housing bubble? Market highs can be both thrilling and daunting. The stakes seem higher, and the fear of making the wrong investment decision can be overwhelming. In this video, I will uncover this dilemma and provide insights from legendary investors Warren Buffett and John Bogle. Should you dive in now or wait for a potential downturn? What strategies can you use to safeguard your investments while still taking advantage of potential market gains? By the end of this video, you'll have a clearer understanding of whether investing in index funds at all-time highs is a wise decision. And in the end, I will show you how much return you can get from a $100 monthly investment over 10, 20, and 30 years. First off, let's talk about the current situation. Passive investing, through methods like dollar-cost averaging, means consistently buying the market over decades, no matter what the market looks like at any given time. But here's the catch. We are currently witnessing one of the most expensive times to buy index funds in history. One key metric to understand this is the PE ratio, or price to earnings ratio, which shows how much investors are willing to pay for each dollar of a company's earnings. And then there is the Shiller PE ratio. For those who might not be familiar, the Shiller PE ratio is like a big PE ratio for the S&P 500. It smooths out earnings over 10 years to give us a clearer picture of market valuation. Right now, this ratio sits at 34.54, a level we haven't seen since the dot-com bubble in 2000, a level that was recently rejected. And we all remember what happened back then, right? So, should we be worried, or should we keep investing, as many financial gurus suggest? For this, let's take a peek at the historical performance analysis. Let's take a trip down memory lane and look at how the market has performed during past peaks. Understanding the history of market highs and the performance of index funds during these times can give us some much-needed perspective. First, let's talk about historical market highs. The S&P 500, for instance, has seen several significant peaks over the decades. Remember the dot-com bubble in 2000? The market was incredibly high, much like it is today. Investors were worried about overvaluation, and indeed, the bubble burst, leading to a significant market downturn. Then, we had the financial crisis in 2008, another period of high valuations followed by a sharp decline. Despite these downturns, the long-term performance of index funds has been remarkably resilient. Take a look at this graph showing the S&P 500's growth over the past few decades. You can see the dips during 2000 and 2008, but notice how the market has recovered and grown significantly over time. From 1980 to now, the S&P 500 has grown from around 133 points to over 5,300 points. That's a massive increase, showcasing the resilience and growth of the market. Let's dig into some real data. According to historical performance, even if you had invested at the peak of the market right before the 2008 financial crisis, your investments would have recovered and grown significantly over the following decade. For example, someone who invested $10,000 in an S&P 500 index fund in 2007 would have seen their investment drop during the crisis. But by 2017, it would have not only recovered, but also grown to around $20,000. This shows the power of staying invested and the market's ability to bounce back over time. Now, let's talk about worst-case scenarios and recovery periods. Historical data shows that while market downturns can be severe, the market tends to recover given enough time. After the dot-com bubble burst, it took about 7 years for the S&P 500 to fully recover its value. The recovery from the 2008 financial crisis was even faster, with the market regaining its peak value within about 5 years. These recovery periods highlight an essential point for passive investors. Patience is key. When discussing market recoveries, it's crucial to remember Warren Buffett's famous advice. The best time to buy stocks is when there's blood in the streets. This quote underscores the importance of not panicking during market downturns. Instead, view them as opportunities to buy more shares at lower prices, positioning yourself for significant gains when the market recovers. But what about those scary periods of prolonged downturns? It's natural to worry about them, but history shows that the market's overall trend is upward. Even during the Great Depression, one of the most severe economic downturns in history, the market eventually recovered and continued to grow. So, should you buy index funds at all-time highs? If history is any guide, the answer is yes. But what does Warren Buffett say about it? Buffett is one of the most successful investors of all time, and he has always been a vocal advocate of passive investing, and his insights can be incredibly valuable for us. Buffett's journey into the world of investing began in 1942 when he bought his first stock. Since then, he's witnessed numerous market highs and lows, and his experiences have shaped his investment philosophy. One of Buffett's key pieces of advice was to invest in a broad index fund and hold it for the long term. He famously said, "The best single thing you could have done on March 11, 1942, when I bought my first stock, was just buy an index fund and never look at a headline. Never think about stocks anymore." To illustrate this point, let's consider one of Buffett's favorite examples. If you had invested $10,000 in the S&P 500 index fund in 1942 and reinvested all dividends, your investment would have grown to a staggering $51 million today. In the end, I will show you how much return you can get from a $100 monthly investment. Buffett's consistent recommendation of passive investing over stock picking is another cornerstone of his advice. Despite being one of the greatest active investors, he often recommends that most people should simply buy a low-cost S&P 500 index fund and hold it. He believes that by doing so, investors can benefit from the overall growth of the economy and avoid the pitfalls of trying to pick individual winners. One of Buffett's quotes that resonates deeply with passive investors is, "I don't know enough to pick the winners, and I don't know enough to pick the winning times." That's why he advises sticking to regular investments in index funds. He believes in the economy's long-term growth and the power of staying invested. During periods of market highs, Buffett's advice remains unchanged. He emphasizes the importance of not making large one-time investments during these times. Instead, he recommends spreading out investments over a period of time. This approach, known as dollar cost averaging, helps to mitigate the risk of buying at a market peak and ensures that you benefit from various market conditions over time. Here's how it works. Let's say you have $1,000 to invest and the stock price is $100 per share. At an all-time high, you could buy 10 shares, but if the market crashes and the stock price drops to $20 per share, your $1,000 investment would now buy 50 shares. And when the market gets back to correction, you are likely to recover faster and have a positive return over the long term. Let's revisit another key point from Buffett. He often says that if you have an overall feeling that business is a reasonable place to have your money over a long period, you should invest over a long period and not make any bet implicitly by putting a big chunk in at any given time. This advice is particularly relevant for new passive investors who might be tempted to invest large sums during high markets. Buffett's perspective is clear. The very nature of passive investing is acknowledging that you don't know enough to time the market. Instead, you rely on the market's long-term upward trend and the resilience of the economy. This approach has been validated time and time again by historical data, showing that even investments made at market peaks tend to perform well over the long run. John Bogle, the genius behind the Vanguard Group and a true pioneer of passive investing, has some insights on market highs too. If you're curious about making smart investment choices, especially during market highs, Bogle's wisdom is pure gold. John Bogle was all about keeping it simple. Buy and hold low-cost index funds. His mantra? Consistent long-term investing is your best bet for achieving financial goals. By putting your money into the entire market, you ride the wave of overall economic growth without the headache of picking individual stocks or trying to time the market. Bogle famously said, "Don't look for the needle in the haystack, just buy the haystack." Instead of hunting for that elusive winning stock, he advised investing in a diversified portfolio that mirrors the market. This strategy spreads risk and boosts returns over time. One of Bogle's core beliefs was to stay the course, no matter how the market swings. Market ups and downs? Totally normal. But they shouldn't scare you off your long-term plan. Discipline is key. Keep investing regularly, even when the market peaks. Bogle and Warren Buffett both championed and advocate passive investing. So the question is, what should you as an investor do in the current market? For this, you need to look at the current market indicators to better understand the present investment landscape and how they might influence your decision to invest in index funds at all-time highs. Firstly, let's revisit the Shiller PE ratio. As of now, the Shiller PE ratio stands at 34.54, a level only seen once and rejected since the dot-com bubble in 2000. This high ratio suggests that the market is relatively expensive. The Shiller PE ratio smooths out earnings over 10 years to provide a more accurate measure of market valuation. Historically, a high Shiller PE ratio has been associated with lower future returns. But it's important to remember that this is just one of many indicators. Another critical indicator is the traditional PE ratio of the S&P 500, which currently trades at around 27.6 times trailing earnings. This is slightly higher than the historical average of around 18, indicating that stocks are priced high relative to their earnings. Such valuations have often been followed by market corrections, but predicting and timing the magnitude of these corrections is extremely challenging. The economic outlook also plays a crucial role in market conditions. In 2024, we're seeing a mix of optimism and caution. On one hand, technological advancements, particularly in artificial intelligence, have driven significant gains in tech stocks. The excitement surrounding AI has pushed companies like Nvidia to reach new heights, reminiscent of the late 1990s internet boom. However, this has also raised concerns about a potential AI bubble, similar to the dot-com bubble that eventually burst. On the other hand, the Federal Reserve's policies on interest rates are a critical factor. As the Fed fights lingering inflation, interest rates remain relatively high. Higher interest rates can depress stock valuations and slow economic growth, which in turn could impact future market returns. Investors are closely watching the Fed's moves, as any significant policy changes could have substantial impact on the markets. Another key point to consider is the potential impact of a recession on future returns. There is an ongoing fear among some investors that the market could see zero returns over the next 20 to 30 years if a severe recession hits. Historical data on past recessions shows that markets do recover, but the timeline can vary widely. For instance, the recovery from the Great Depression took several years, while the recovery from the 2008 financial crisis was relatively faster. Despite these concerns, historical data provides some reassurance. Even during periods of high valuations, the market has shown a remarkable ability to recover and grow over the long term. Remember our example of investing $10,000 at the height of the 2008 recession? Not only did that investment recover in 10 years, but it also yielded over 100% in returns. So, what should you do as an investor? Well, here's my take on it. Many of us haven't experienced investing during a recession firsthand, and if there's one thing I know and have learned from my time in the field, there is a reason why investors like Buffett sit at the top. Here's my game plan for times like these. I'd stick with the dollar cost averaging approach. That means consistently investing a set amount of money into the market on a monthly basis. Sure, the price to earnings ratios or Shiller PE ratios might be a bit on the high side. But let me tell you, the market is buzzing with dynamism and innovation like never before. If you want to follow the same strategy, here's what the future outlook will look like with $10,000 in the S&P 500 index. Over the past few decades, the index has been growing around 10.70%. Based on this, if you invest $1,200 as an initial investment and $100 each month to take into account dollar cost averaging, here is what the projections look like. By the end of the first year, you will have around $2,528. Fast forward 10 years, and the investment amount will total $12,000, resulting in an over 100% return, meaning a portfolio value of $23,095. The portfolio value after 20 years will be $83,606, and in 30 years, your portfolio will have a valuation of $250,838. Meanwhile, your total investment over 30 years will stand at $36,000. That is a 593.44% return over 30 years. And if history has proven anything, it's that even during the market lows and highs, it has maintained similar performance over long periods of time. Now that you know what to do in the current market, click the video on the screen to see stocks that have the potential to hit a $1 million portfolio valuation.